If you're a bigger risk taker, you might want to have a flair to have international names. So in this country, as an example, you have Ford and you have General Motors. But Mercedes-Benz makes cars, and Nissan and Honda make cars, and Audi and Maserati and Porsche.
When you need some advice, never sacrifice, always get it right. Ask the Planman. Finance, insurance, and more.
Hi everybody, welcome to Ask the Planman. If you need some advice, you always want to get it right, you want to come ask the Planman. I have a belief that each and every one of us should be proactively planning their financial futures, taking charge of control. Today, we're going to talk a little bit further about asset allocation, rebalancing, what goes into a model allocation. Last episode, we talked about some of the mistakes that I made over the years, how I want clients and individuals out there, new listeners, to be proactive, start as early as possible. We talked about the power of compounding and most importantly, not losing money, not going backwards. And so, Ali, I want to start today. Ali, my producer, is with us. I was thinking about this morning because the market dropped yesterday. The Japanese market dropped 12% overnight over the weekend here. Again, we try not to timestamp, but this is early August 2024. And we woke up Monday morning to news that the Japanese market dropped 12%. And it sent tremors into the U.S. market. And so it made me think about, we talked last episode about the power of compounding. So if you had $1 that you had just invested and it loses 12%, you now have 88 cents working. How long does it take for that 88 cents to grow back into your dollar? And if you don't buy more at 88 cents, it's going to take you even longer to get back to even. So if you made 10% the next year, last episode, we talked about the historical rate of return on stocks is between 10 and 12%. So let's just use 10. So if I lose 12% right off the bat, I invested Friday, I wake up Monday, I'm down 12%. I'm more than a year, almost a year and a half, just to get back to even. If I make 10% on 88 cents, I made 8.8 cents. 8.8 is 96.8. Took a whole year. I'm still 3.5% short, which means I need almost another third or fourth of a year, assuming no more setbacks, just to get back to even. And I've lost a year and a half on my calendar and my clock. So when we talked on the last episode about not investing when the markets go down, stopping your investments, freezing your accounts, just riding it out, the key to making money is buying in the downturns, buying when it's 88 cents. And if it drops another 10% and goes to 80 cents, buy a little bit more. So you'll hear the term, Ali, dollar cost average. That's what we were touching on last time, kind of making fun when the markets go down or you have a sale at your store, your Macy's goes on sale, and we don't want to buy when something's 40% off. Well, if your stocks are down 40%, it's going to take how many years to get back to even? I was in the business when the market crashed in 87, dot-com in 2000, the housing crisis, and numerous ones in between. I've seen 30 and 40% corrections. So if a client watches $1 go to 60 cents and the historical rate of return is 10%, it's going to take 5 to 7 years for that dollar to get back to even. And that 40-year-old is now 46 or 47. So it's imperative to buy more at 60, 65, 70, 75, 80, 85, 90, 95 and up. So the dollar cost averaging is what most individuals do, whether they understand the terminology or know it. When you put money in your retirement plan at your 401k or TSA, and you're putting money away in a monthly savings program, payroll deduction, put my $200 away. You're dollar cost averaging, Ali. You're buying in March, you're buying in May, you're buying in October, you're buying in January. Every month, the markets are going up and down. Somebody shared a statistic. Markets go down 30% of the time. Goes up 70% of the time. So the key areas are what you do during those 30% down months, weeks, years, whatever it is, and take advantage of those sales. And then when it goes up to 70%, you're going to make your money. But we want to talk more about diversification and asset allocation as we tie this in, because the dollar cost average is going to help do a big part of that for us. We're going to buy at $50, $52, $47, $38. We talked about Apple last time going from down to $75. So Apple was, when the market crashed in 2008 and 2009, Apple went from roughly $150 to $75. A lot of people got hurt. A lot of people bailed out. A lot of people sold at 75 and walked away. And we said Apple's worth 28 times that value and more. Apple's over $200 today, but it has a split adjustment of 28 times. Now you go buy Apple today thinking it's only $200, but the person who bought it at $75, they're in that stock for 1/28th the price that you are. So are you going to be able to catch up to them? Never. Never. You can't go back in time. But if you bailed out at 75 or you failed to buy it at 75, well, maybe you bought it at 80, maybe you bought it at 90, maybe you bought it at 125, maybe you bought it at 300. And then it started to go up, and then eventually it split, and it went up again, and it split again, and here we are at 200 and change again. That's where time is your biggest ally. So you want a dollar cost average. You want to keep buying your shares in your mutual funds, your programs through work. We were de-emphasizing people really buying individual stocks last time, proper diversification. Unless you have, large sums, $500,000, $1 million, maybe you shouldn't be buying individual stocks. That's not for me to determine. You determine your own risk. I'm not telling you what to do, but I've counseled people over the years. Most people are in mutual funds. Mutual funds will be made up of 50, 100, even 200 different stocks. Any one stock having a bad day, a bad business cycle, disappointing earnings are not going to kill you. You wake up tomorrow and Apple doesn't do well, missed their quarter, had a fire in their factories, can't deliver their new phone, and Apple drops 40%. That could be very painful if all your money's in Apple, right? Even if you did make all that money. Nobody wants to see their stock go down 40%. Nobody wants to see the stock market go down 40%. So you need to be diversified. So we're going to talk about asset allocation, Allie. We're going to talk about diversifying your money. When we talk about financial planning and the journey, my book that's going to be coming out, we talk about the journey of retirement. We talk about the rate of speed, how fast or slow you need to travel to get to where you want to be. It's the backbone of my retirement planning seminars for many years. And I tie that into the journey. Can you afford to make 7% and meet your financial goals? Can you make 9%? Can you afford the risk of 12%? What does all that mean to you? And so then you tie that into asset allocation. Is how do I diversify my portfolio to give me a risk-adjusted rate of speed, a risk-adjusted rate of return? So if all my financial planning says, Allie, all you need to do is make 7%, your asset allocation will be divided or built to only take the risk associated in making 7%. Old saying in my business, you like to eat better or sleep better. If you like to sleep better, you don't want high volatility in your portfolio. You don't want to wake up to the news worrying the market dropped 40% overnight because of global escalation of some problem or global depression and recession. Okay? So having done this for so many years, I've seen market cycles, I've seen market corrections. It takes years to come back from that. If you stop investing, if you're retired and don't have new money to invest, you can't afford to wake up and see 40 cents disappear of your dollar. So you need to protect that money. And we talk about that in using other vehicles like maybe annuities to protect some of that money in the downside. But for asset allocation, not using annuities, you want to have your money properly diversified. And we want to share with the audience a little bit about what that means. Well, there's value stocks and there's growth stocks. We talked about that a little bit in the last episode. A value stock is usually a more mature, I'll use the term older for lack of a better word, mature company. The value is in the steadiness of their performance. They're not sexy. They don't have the next, artificial intelligence chip that's going crazy these days, right? But they're a steady Eddie, and they're going to give you a dividend. They might be a Verizon, they might be an ExxonMobil, a Chevron, a Pfizer, or Merck. They're always innovating, coming up with new things, but their sales is steady. Their revenue is steady. There's a certain expectation of growth that you're going to get with them and a dividend. So people are value hunters. They look for maybe higher dividends. That's part of your total rate of return. If you get 4 or 5% in a dividend and you're looking for 7 or 8%, you don't need much more growth out of the stock than making sure that dividend is secure and goes up every year. So as people get older, they'll start to put more money or start putting their money in value. As they get older and older, they'll want those dividends. They'll reinvest those dividends till retirement. And then maybe they start using those dividends as income streams in their retirement, kind of like a bond might do or a CD. But they know the company's probably not going to go out of business. But even the best of breed runs into problems. Exxon Valdez had an oil spill. The stock got clobbered. Johnson & Johnson had talc powder lawsuits. So, stuff happens. That's what free enterprise and capitalism is all about, is these companies take risks. They do things. Stuff happens, environmental or otherwise. They didn't know it was going to cause cancer. Talc all of a sudden is causing cancer. People put talc in their armpits and it got into the lymph nodes, and all of a sudden they're losing millions and billions of dollars in lawsuits and the stock gets hammered. And until that cloud disappears, that stock's going to be out of favor. But if I worked at J&J, if I owned a lot of J&J, I got to ride that out. Recently, Intel, one of the biggest well-known chip makers in the computer industry, most people's computers are going to have a chip made by Intel, depending on how old your computers are. They were the front runners in the 80s and 90s. They were the company that made computer processing chips. They're going through bad times right now. They just suspended their dividend. So if you were buying Intel for the dividend and some growth and thinking you're in technology and you're playing in that space, your stock just got whacked 30, 40%, and they cut your dividend. A lot of people are bailing out on it. So do you ride it out? Do you go find another horse? What do you do? If you didn't see it coming, you're waking up, you're having a bad day if that's a lot of your money in that stock, right? And it's going to take years for them to turn around. I'm not saying they will or won't. I have no idea. But if I've got my money over leveraged in that stock, I'm having some bad pain right now. And that's how people make mistakes, on emotion. They don't have the logical side overrun the emotion side. The emotions take over of, oh, gee, now I'm down 40, 50%. What am I going to do? Well, a good investor, good portfolio manager is going to take their losses and move on. There's always another train coming. There's always another horse to get on. You riding a bad investment vehicle out with no idea of the forecasts and how long it's going to turn around, there's a million other stocks to pick. Sometimes it's best to just take your losses, walk away, and go find another horse to put your money on. And maybe it's Apple, maybe it's, Nvidia, maybe it's, whatever it is. And again, I'm not telling you to go buy any of those stocks. Just using names that people are hearing in the news these days for relevance. Okay? So, making sense so far, Allie?
Yeah, following along.
All right. So, you have value and you have growth. Growth are going to be your innovators. They could be more speculative. They're not necessarily making a lot of money yet, but Amazon in its day was losing money left over right, and now eventually they're a behemoth, right? They invested, they kept putting the money back into the markets. So your asset allocation is designed to manage risk. The risk is being managed by properly diversifying your portfolio. We're going to use the mutual fund concept, not individual stocks. I keep referencing stocks only for a frame of reference, but you have a value portion and you have a growth portion. How much money belongs in value? How much money belongs in growth? Then you have international stocks. If you're a bigger risk taker, you might want to have a flair to have international names. So in this country, as an example, you have Ford and you have General Motors. But Mercedes-Benz makes cars, and Nissan and Honda make cars, and Audi and Maserati and Porsche. They're all car makers, not in the USA. They're on different stock exchanges in their countries. Germany, Japan, Italy. Okay? So you might be a big fan of Porsche. You might want to buy and invest in Porsche stock. That's an international investment. That's an international fund that will buy the banks, the brokerages, the real estate, the car manufacturers, the pharmaceutical companies, the tech companies. They're not all US based. So you might want to have some international exposure. Cash and bonds are asset classes. Now these days, Bitcoin, cryptocurrencies become an asset class. Gold and oil are asset classes. So when you look at, I don't have the visuals here, but when you look at an asset allocation, you're basically talking about a pie chart. And now you're dissecting your slices and your pies. And so how much money goes into each slice of that pie will determine your risk. If you're 100% growth stocks, you're on a jet rocket. If you're 100% in cash, you're snail mail, right? So how much money should be in cash? How much money should be in those jet rockets and everything in between? And so the asset allocation helps you define that risk. It backs into the risk and says, and there's lots of models out there. We work with a professional to do it. You sure can find it online. Is you want to say, I want to make 7%, 8%, 9%, 10%. What's a model allocation that matches up to that? How much money in stocks versus bonds versus cash? If I'm a younger person, I probably don't want bonds. I certainly don't need a lot of cash. If I'm an older person, I'm going to want to have some cash. I'm going to want to have bonds. I want to be a little bit more secure and keep the ship tighter. I don't want a lot of fluctuation and volatility. That make sense?
Yep.
So, Allie investing in her 30s versus me in my 60s, they have a lot more time. They might want to be more aggressive. They don't need to be in a portfolio of cash and bonds making 3%. They want to make 15%. They want to be investing in technology stocks. They want to be investing in pharmaceutical new wave medications, right? They want the growth and the upside of innovation. And that's where the markets make their money, is new things, new inventions. 15, 20 years ago, people didn't hear about the things that are the hottest craze today, but now all of a sudden here they are, right? Tesla, electric cars, SpaceX. And now artificial intelligence is the hot craze, and everybody's going crazy for that innovation to take hold. And so people are investing millions and billions of dollars. All the big companies are investing in that. And there's going to be a whole new wave and new evolution that's going to come from it. So how do you invest in that? Remember a few years ago when cryptocurrency was coming about, everybody wanted to know, how do I get in on it? You couldn't. There was no access. How about when cannabis was being legalized and now you can buy and, companies that grow and harvest and sell cannabis, right? It's all changed in the perception of this country. They used to be illegal. Now in a lot of states it's not. So people want to invest in that. I want to get in on the ground floor. I want to get in before everybody else does, right? It's going to eventually be legal in all 50 states maybe. I want to take part in that. So I'll call in the Warren Buffett. People invest in what they know and what they use. They start there. So if you look at the holdings in the portfolio that Warren Buffett used over the years, McDonald's, Nike, Dairy Queen. Like, he loved to go to Dairy Queen. He loves his ice cream. He invests in Dairy Queen because he thought they had a good product, right? So people bought Disney because every year they took their kids to Disney and they watched the movies. So they bought Disney stock, and the kids love McDonald's and the Happy Meal, and they bought McDonald's stock. They buy what they're familiar with. But if I start naming 15, 20 stocks, you have no idea what they do. You're going to be pretty speculative and resistant to want to put your money in it because you don't know what it is. But if I'm in McDonald's every week buying my kids a Happy Meal and I see the crowd, I'm like, well, they must have a good business. Maybe I should put my money in some of that. And that's how people start. Or they work for a company that's publicly traded like Merck, or AT&T, and they just buy their company stock because they work there and that's what they're familiar with. And that's dangerous in and of itself because they may not diversify properly. So we're back to diversification. Huh? Say it again. I'm sorry.
That whole story about them in the episode with Anne. You dove into that. So if anybody wants to know a little bit more about that, they should go listen to Anne's episode.
About this individual stocks and potential collapse.
How people went from being millionaires to living on food stamps.
Yeah. Well, Lucent's a great story, a warning story. And I have .com stories when the market had the .com bubble burst. We had a client that had $500,000 in Cisco stock, which was part of the crazed, AOL and Dell and Gateway and, the forerunners, DoubleClick. This, if you're old enough to know these names, if you're young enough, you don't, but 20 plus years ago, we had a different .com craze, unlike technology today with the Apples and NVIDIAs and the Googles and the Microsofts and the Mag 7. But back then we had the Nifty 50 of tech names and Cisco, Intel, Sun Microsystems, DoubleClick, AOL, names like that, Yahoo. And people were making boatloads of money. And one of them was Lucent Technologies. And Lucent went from $3 to $75. And then the bubble burst and the stock went to 75 to 60 and people were buying more at 60 and averaging down. It went to 50 and they're averaging down. It went to 40 and they're averaging down because they think it's going to go back to 75. And then it goes to 30 and it goes to 20. And how much are you going to keep buying of this thing? And we talked earlier about sometimes you got to know when to walk away. And the stock went all the way down to 75 cents from $75. And then they sold to Alcatel, I don't know how many years later, for like $3. So people got destroyed on something they made millions and millions of dollars on, riding it from $3 to 75 and buying it all the way up and then figuring every downturn it would just go higher. And they kept buying more and more and more. But Ali, you know what it did? It became more than 4 or 5% of their portfolio. It became 50 and 75% and 100% because they believed in it so much. And they never thought the music would stop. And the stock cratered. I had that experience. What we talked in last episode about being vulnerable. I used to work for Wachovia Securities. It was owned by Wachovia Bank. It was a brokerage unit, part of the bank. And I accumulated in 9 years, I'm going to be vulnerable here, $500,000 of Wachovia stock. Wachovia Bank was the number one rated bank in the early 2000s, 2005, 2006, 2007, paid a 5% dividend. I was getting $25,000 a year in just dividends that I was reinvesting and buying more stock. And the stock went to $60. And I had $500,000 worth of stock at $60. And then the housing crisis hit. And they got exposed for the toxic assets that they had, and Wachovia failed in September of 2000. And I woke up to a stock that was $1.25 from $60, lost 98% of its value. My $500,000 of Wachovia stock became less than $10,000. That is an ugly story. And it happened to me. And here I'm investing prudently and, buying a very conservative bank. And I work there and I had other assets and other, parts of my portfolio, but I had amassed and had expected that stock to just keep cranking out its 5% and compound the heck out of that thing. This is how many years ago we said? Almost 20, 18 years ago. So imagine what that stock, if I never put another penny in, if I made 5% in dividends, my money doubles every 14 years. I'd have $1 million plus without the stock even moving. But we talked in the last episode about not losing money.
Yep.
The key to investing is not losing money. I lost $500,000 because the stock hit the shitter. And I'm going to say shitter on my show. Okay, the stock shit the bed. The market, the financial crisis, others did worse. Lehman Brothers went out of business. Bear Stearns went out of business. Citigroup, Bank of America, Merrill Lynch, like everybody, anything in the financial space was teetering on the brink. And at $1.25, $1.50, Wachovia got bailed out and is now part of Wells Fargo. But my money's gone.
Yeah. And if you had if you had diversified that 25,000 annual dividend that you were getting into other things.
But I made a big bet, folks. This is the mistakes. Shows now are my mistakes so you can learn. Okay. We always were. I didn't finish the Cisco story, by the way. We got to come back to Cisco. But so I'll tie it in. So the Cisco story, this lady had stock options in Cisco during the dot-com craze. She had $500,000 of profits, and her accountant said, don't sell. You're going to pay too much in tax. And so she never sold. We tried to get her to diversify, put her money in different asset classes, different stocks, value versus growth, and take some of that money off the table. And because of taxes, she didn't do it. And so the lessons I always say is don't let taxes and commissions get in the way of locking in your profits, whether it's real estate or stocks or anything else. If the markets are peaking, you need to know when to sell at least some of it, if not all of it. So then the market crashed, her Cisco stock went down, and she lost her $500,000 of profits. So she had no tax to worry about, and she had no $500,000 left that she would have diversified in something else. And it was gone. And so tie that into my Wachovia stock. I accumulated stock for 9 years. I didn't make one big bet all at once. I was buying and dollar cost averaging and accumulating a position of size in one company. And be sure it was more than 5%. I had no business, looking back now, having all of that money. Even if I was worth $1 million, that's still half of my money. I wasn't worth, probably, I don't think I had $1 million at that point, but maybe I had 750. So I had 2/3 of my money. Okay. Whatever it was too large of a bet, and I became my own worst enemy. And now 9 years of savings from year 2000 to 2009, 2008, I'm 37 to 45 years of age. And all that I accumulated, the majority of what I accumulated, vanished. Vanished. Not a small loss, 10 or 20%, wait for it to come back. 98% is not coming back. There's no miracle in the world that's going to pull that money back. And so now I flushed $500,000 down the toilet. And that money today, and the names we talk about all the time, if I had put that money in, if's the biggest 2-letter word in the world, how many millions would I have had if I was properly diversified, didn't lose that money, and kept compounding it out? But again, that's what makes a stock market. People make their bets. I thought I had something of value and conservative. I wasn't playing tech names. I wasn't playing crazy risk games. I was buying a blue chip bank stock, for God's sakes, with a 5% dividend. And they let me down. They failed me. They failed a lot of people. Their investors got destroyed. Mm-hmm. And so we want people to learn from that.
It's a cautionary tale.
Man.
Yep.
Ain't I a big one?
I know this episode has lots of cautionary tales in it, but it's not all bad. Yeah, I know we talked about Anne's episode a little bit earlier. There is some good stories in Anne's, and I know you've seen some success as well along the way.
Sure. Oh, I've helped. Listen, you can't go by me and my mistakes. Do as I say. Shoemaker's daughter, right? The shoemaker's shoes, whatever it is. You do as I say, not as I do. So, I didn't do these things. I didn't allow my clients to do these things. We properly diversified them, but I was my own worst enemy. I didn't have an independent financial advisor. I put my money where I thought I could outsmart people. That's why we're doing these shows now, to be humble and to be vulnerable and say, these are mistakes I made, and I don't want you to make these mistakes.
Exactly.
And don't get caught up in it. Okay. I've shared several stories now that have cost me millions and millions of dollars. I don't want people to make those mistakes. So in Ann's case, she never made those big bets. She let her money work. She was conservative. She saved. She invested. She rode through the market cycles. She didn't panic. She didn't try and time the market. And she accumulated and she accumulated and she accumulated. And then she dialed down her risk as she got closer and closer into retirement. And now she doesn't want to give it back. So she's going to be tighter and tighter. So again, these are the lessons. I'm going to wrap us up here, Allie. We talked about diversification a little bit. We talked about asset allocation. I really didn't get into the whole rebalancing thing a little bit, but our time is running out for today's episode. We'll do another episode on this, folks. We'll keep this conversation going. I got a million war stories, and we're going to keep bringing them to you. So hopefully you can take some lessons from this and improve your situation or motivate you to do things. So anything else before we go, Allie?
Just to thank you for getting vulnerable and sharing with our audience today and sharing with me.
Yeah, we're turning a new leaf over on the plan, man. We're going to be sharing some more experiences and stories. Hopefully going to have more people like Ann on to share their stories. So hopefully, folks, please like, share, subscribe, share this episode with your friends. It's a wake-up call for everybody and anybody out there. The stock markets are going to be swooning. They are swooning now. They are going to swoon again. They always have ebbs and flows. We've had a strong economic cycle. I've seen market corrections. I can tell you, I don't know when, but I know it will eventually have significant pullbacks again. This country's printing tons of money. Inflation is getting higher and higher. Nobody knows for sure what's going to happen. Oil prices, Middle East tensions, elections coming up. Protect your money. Protect your money. Make sure you know what your money's doing. Take heed to this 61-year-old person's 38 years of experience. What goes up comes down. Make sure you don't give it all back. Protect your money where and how you can. Don't be greedy. Taking profits is okay. Bulls make money. Bears make money. Pigs get slaughtered. I was a pig in Wachovia stock in the early 2000s. I allowed $500,000 of my net worth to disappear out of my control because of economic conditions and decisions a bank and a business made during the housing crisis, creating the housing crisis that cost me well over $500,000 at that time, which would be worth millions and millions of dollars to me today. Don't make those same mistakes. We'll see you next time.